Most people go into retirement assuming their taxes will finally drop. No paycheck, no work income, so the tax bill should get lighter. What surprises a lot of retirees is that for many of them, taxes actually get worse. Not louder, not dramatic, just quietly more expensive. And it usually comes down to one decision that they did not even realize they were making. This is what I see behind the 8 retirement tax mistakes that secretly cost retirees more than they expect. If you're retired, close to retirement, or still saving while assuming taxes will sort themselves out later, this matters. Because the biggest retirement tax mistake is not bad investing, and it's not market timing. It's following advice that sounds logical until real life shows up. This video isn't about advanced strategies or exotic moves. It's about something much simpler. The order you pull money from in retirement and why that order controls how much tax you pay over time. Once you see this, retirement taxes stop feeling random. They start to feel predictable. I see this pattern constantly when reviewing retirement plans. People save diligently for decades, but no one ever helps them plan how to take the money back out. And that missing setup is usually where good savers end up with bad tax outcomes. And that is why I want to slow this down and show you how it actually plays out. When you're working, taxes are straightforward. You earn income, taxes come out, and you move on. But retirement doesn't work that way. Instead of one income source, money starts coming from everywhere. Social Security, retirement accounts, investments, sometimes even a business. Each one follows a different set of tax rules. Nothing looks broken, but the math starts changing underneath you. This is where retirement taxes start to feel like a trap. Not because of one big tax bill, but because of small thresholds that you didn't even know existed. Social Security that was supposed to be tax-free suddenly isn't. Medicare premiums jump, not gradually, but in steps. Investment surtaxes appear once income crosses certain lines. And the frustrating part is how little it takes. $10,000 or $20,000 of extra income can flip multiple switches at once. So the issue usually isn't how much money you have, it is how you access it. This is where well-meaning advice creates bad outcome. Most retirees are taught the same rule. Spend taxable money first, then pull from tax-deferred accounts and save Roth for last. On the surface, that sounds smart. Why touch pre-tax money early if you don't need it? The problem is what this rule ignores. By delaying pre-tax withdrawals, retirees stack future income. Required minimum distributions pile on top of Social Security. Tax brackets compressed. Medicare premiums jump. What felt like patience early on turns into tax problem later. The worst part is that this usually shows up later in retirement when flexibility matters most. This is easier to see with a real example. Jim and Carol retired with about $3 million. They have a traditional IRA, some Roth money, a taxable investment account, and Social Security that starts later. Nothing aggressive, nothing unusual. Early on, plans feel smart. They live off taxable investments and avoid touching pre-tax money. On paper, income looks low. Taxes feel manageable. Everything seems fine. Then, timing catches up. Required distributions start, and Social Security turns on, and income stacks from places they weren't using before, even though their lifestyle hasn't changed. Then something normal happens. A roof needs replacing. Medical expenses come up. They need about $40,000. They pull it from the traditional IRA because that's what they have always been told to do. That one withdrawal pushes their income high enough to trigger higher Medicare premiums and make more of their Social Security taxable. Not just this year, going forward. They didn't run out of money, but they ran out of options. Here's the part most retirees never hear. The goal is not to avoid taxes forever. It is to choose when you pay them. And the best time to pay taxes is often earlier than people expect because early retirement years are usually low tax years. Once those years pass, you don't get them back. More intentional retirees pull some money from pre-tax accounts while brackets are still low. Not because they need the cash, but because they're buying flexibility later. Think of it as locking in today's known tax rate instead of gambling on tomorrow's unknown one. That shift alone can change lifetime taxes dramatically. Here's what that looks like in real life. Two people sit comfortably in the 15% tax bracket. They don't need extra spending money, but they intentionally withdraw $100,000 from pre-tax accounts. They pay about $15,000 in tax, then reinvest or save the rest. That small intentional tax bill prevents much larger ones later. And psychology, this is the hardest shift to make, paying some tax on purpose so you don't lose control later. Early retirement also opens another door most people miss. Capital gains can often be realized at very low, sometimes even zero tax rates. Instead of avoiding gains completely, retirees can trim concentrated positions strategically. They reduce risk, they reset the cost basis, they keep keep income flexible, this isn't about spending more money, it's about repositioning smarter. If you give to charity, this becomes even more powerful. Donating appreciated stock instead of cash avoids capital gain entirely. Qualified charitable distributions reduce future required withdrawals. For many families, this quietly saves tens of thousands in taxes, not by giving more but by giving differently. This part surprises almost everyone. Roth accounts are often treated like sacred accounts you never touch, but sometimes Roth should come first because Medicare premiums are tied to income cliffs. One traditional withdrawal can push you into a higher tier. A Roth withdrawal could have covered the same expense without triggering that chain reaction. And that is why Roth isn't just tax-free money. It's a control lever, and all of this only works if you have these 4 important options: tax-deferred accounts, Roth accounts, taxable investment, and charitable strategies. This is tax diversification, and it's just as important as asset allocation because flexibility is what gives retirees year-by-year control instead of one locked-in outcome. If you're not retired yet, this is how you avoid the mess. Use employer matches first. Fund Roth options when they make sense. Max out HSAs, then build taxable investments intentionally. The goal is not deductions, it's future flexibility. Retirement taxes aren't inevitable. They're usually the result of unplanned withdrawals. Once you understand sequencing, the fear disappears and decisions stop feeling reactive. If you want to see another place where planning early creates outsized tax savings, watch the next video on 2026 HSA changes. That video breaks down how HSA can quietly become one of the most powerful tax tools in retirement and how upcoming rule changes can triple the benefit if you use them correctly. It connects directly to everything we just talked about. See you in the next one.